Hello, everyone. Can you? I hope you can hear me. There's a chat thing that you can put questions into. I think, although we screwed that up last time, and I don't think I did anything different this time. So maybe you have power to type stuff into that chat thing. Maybe you do not. If you do not, you can type things into the Q&A button on Zoom. And if you're on YouTube, which I think, Chris, are we on YouTube at the moment?
We are, mate. We are live on YouTube.
Wonderful. Wonderful. There we go. So if you're on YouTube, type stuff into the chat thing. Chris will pick up those questions and we can pick that. Cool. Right. It's 10 p.m. for me. So I'm a bit tired. But I will endeavor to at least appear to not be tired whilst we do this. So last week we had what I thought was a pretty good session where we talked about the kind of essentials of getting a trading edge. And we talked about how you're always trading against prices set by other people. So you need to find occasions where you can trade with people at prices that are bad for them, but good for you. Yeah? And that is hard. Right? That is hard because lots of other people are trying to do exactly the same thing. So there's a kind of competitive market for trading with people at bad prices for them. Yeah? And what we found generally needed to be the case was that you're finding opportunities to do useful things in uncompetitive areas that kind of suck a bit. So you're doing useful things like helping people out, trading with people who are maybe price insensitive or forced or trying to achieve something else. So you're not kind of in a competition essentially for prices. But you are in competition with people taking the other side of that. So it's important to think about both of those things. You know, how can I trade with someone at a price that's bad for them, good for me? We generally do that by finding people who don't care that much about price to trade with. Then we say, well, how do we get to be the people that take the other side of that? That usually involves doing something a bit murky, right? You know, something in an area that's a bit distasteful or something where we can't quite pull out enough money to make other people interested in it. And that was effectively the basics of getting edge. And I called that doing useful things that suck. That was high level trading stuff. Now what we're going to do today is look at research. So look at how we think about research, which is that if we've got some trading idea, how do we then go and look at the past data or current data and say, well, does my idea seem to be supported by enough evidence in what I can observe? Okay? And that's today's job. And what we're going to concentrate on today is how to approach the research problem and what's going on in my head as I do it. So what I'm not going to do today is teach you anything technical. All right, the technical stuff is relatively easy. You know, it takes time to become good at moving data around and doing analysis, but it's pretty easy, right? You know, you just have to be a bit patient, do it. Those skills will come. The difficult thing, I think, is, well, how do I pose a sensible research problem, and what am I thinking about while I'm doing it? And I'm kind of calling this here the inner game of doing research as a trader. And the most important thing that I want to talk about first is the importance of putting the market effect or the pricing inefficiency ahead of the trading strategy. Now, a trading strategy, at least in my mind, is a set of processes to exploit a market effect. The thing that comes first is the market effect itself. Okay? Everything that you do in your trading strategy or in your set of processes is informed by what is actually the market inefficiency that I am trying to harness in the first place. Okay? So where we're going to focus today mostly is here. How can we use our understanding of the market as a system, a bunch of structure and parties and bots and people who are scared and people who are who are wild and the kind of crazy adaptive system. How do we use our understanding of that system along with some very simple data analysis techniques in order to investigate whether there's some serial mispricing that we might be able to design a trading strategy around? Okay? Now, the reason I put this slide together is that I observe a lot of people who start here. Right? Their kind of default starting point is to start at the very end of the process and effectively just try out a bunch of trading rules in order to see whether they make money. And due to the enormous amount of kind of noise and the kind of terrifying efficiency of the market, you're not really going to have any success whatsoever with that kind of thing. Like you're just going to find mirages everywhere. So you've really got to focus on why is there some kind of repeatable opportunity to trade at attractive prices? If there is, who created it? Why did it persist? Why do I think it will persist in the future? Can I then look to see if I can find a lot of evidence of it existing in the past? Then can I build a trading strategy around that? Okay, so start in the right place. Don't start at the end of the process. The question about last week's video, there's a replay on YouTube.
I'll just post the link in the
rewound myself there, Chris.
I've just shared the link there.
Okay,
Ewan,
cool.
For the person who asked that. Yeah.
So first mission, start with an idea. Start with an idea about why a mispricing would exist in the market. And for that, really, I think you need to know these two things. You need to know why is someone wrong? Why would someone or some group be willing or forced to trade at bad prices for them? And that might be because they don't know something you don't know. But it's probably not, right? It's probably that they are trying to achieve something other than get the best price. Maybe they're tax loss harvesting. Maybe they're doing something entirely systematic. They're not even looking at value. But you need to have some idea of, who's wrong, who's distorted prices. Then the next bit is, why isn't the impact of the wrong person? There's a lot of wrong people throwing money around. Why isn't that fully absorbed by the market? There's a bunch of smart people doing arbitrage, taking the other side of things for small amounts of edge, right? Why can I find a mispricing that distorts the market so much that I can make money from it? Okay? So I need to know why other people aren't taking the other side of it. So, because I know I'm not the first person to find anything, right? I need to know why other people aren't taking the other side of it such that they've essentially traded that out of the market. And really that comes down to it sucking. Right? I want to understand what it is about that opportunity that is unattractive and other people aren't going to exploit it fully. Okay? So that's my primary objective, right? That's number one thing, and it's got nothing to do with maths. It's got nothing to do with data science. It doesn't even really have much to do with finance, right? That is a human system. It's fear, greed, bots, arbitrage, stuff like that. It's murky stuff. We need some economic rationale why we'd be able to trade. Why we'd be able to trade at good prices. Right, it's gambling, right, Chris? That's what it is. It's getting edge. Now, if you've got your idea, Now we go to the data. Okay, now we go and say, well, hey, look, if this was true, what would we see in the data? And we go and look for it. And what we're really doing there is we're not trying to confirm anything, because we can't really. We're just trying to collect a lot of evidence and see to what extent does it line up with my story here? To what extent does it not line up with my story here? And then, we'll find some of it does, some of it doesn't. Sometimes it's really easy just to throw out ideas, right? Because they just look terrible from the first thing you look at. And that's great. Most of the time, you've got a bit of evidence pointing in this direction. You've got a bit of evidence pointing in that direction. And you've got to make some kind of decision under an enormous uncertainty. And that's really the game, right? So how do you do it? How do you do this research bit? Well, you just do it a bit at a time, right? You chunk down, you do a little bit, you chunk down, you do a little bit. Okay. Definitely what you don't want to do is create some grand project in order to get an answer. Okay. You want to try to discount ideas as quickly as possible. Yeah. And one of the reasons for that is that things in the market typically only get worse the more that you look at them. So, if something doesn't jump out at you as looking relatively attractive at a high level straight away, you can probably drop it pretty quick and move on. So what you should be doing in your research is prioritizing how can I, given what I have available now, or what I can get quickly, how can I discount this idea as quickly as possible? So effectively, I'm going, hey, look, what would I expect to see in the data if it were true, right? Or in other words, the first time you're doing it, what would I need to see? Otherwise, I'm going to give up. Right? What can I need to see? What do I need to see that I can get the answer to quickly, even if it's not perfect, that if I know the answer, I might be able to drop this and give up. Then I look for it as directly as I can. Then I keep asking questions around it. I say, hey, look, what other than my pet idea about what I'm looking for would explain this thing? And I loop around, right? And the important thing in my kind of research mindset is to just be really skeptical about everything. You just have the word bullshit in your mind and just notice when you're being hopeful, when you're allowing yourself to get away with sloppy thinking, when you're accepting things that you shouldn't accept. And when you're doing that, just you're the easiest person to bullshit. Just call bullshit on yourself, then work out what assumptions you're making, chunk it down into a thing to look for. If that were true, what would I need to see in the data? And then go and look for it. Right? And move fast and don't be prissy. Right? Don't get stuck trying to create the perfect analysis. Just get moving. Right? Just go into it with eyes open, understanding in what way your data is biased, or what way your analysis is biased, or in what way your analysis is a bit shonky, or whatever. And you don't have to pressure yourself to do it right. Just keep moving, keep looking at the data, keep thinking about what you're seeing, what you're not seeing, and you can loop around that process. It's a process of sort of curiosity. Right? Be curious, be skeptical, try and disprove the thing that you're seeing. Okay. So that's all very well, right? That's all very well. Let's look at an example. And I had a bunch of examples that people, or ideas to look at that people submitted to me. I've picked this one, which is actually one that a trade that I went through in the session last week, which is funny little dislocations around the end of month in government bonds. So this is going to be a quick recap of the stuff that we talked about last week. Then we'll go into the data and we'll actually have a look at the effect. Now, imagine you are a fund manager. Okay, you're a fund manager and you have to make disclosures of the positions you hold at month end. Now, if you're going into month end and you're holding some particularly trashy things, you might be tempted, so that you don't have to have an awkward discussion with anyone, you might be tempted to sell down that stuff and potentially replace it with high quality assets such as treasury bonds. Now, what this might do is that might lead to excess demand for treasury bonds towards the end of the month, as sort of various people who look like this guy might be tempted to do that kind of thing on average, which may well lead to treasury bonds becoming slightly too expensive coming into the end of the month. Now, this would be an example of price insensitive flows creating a pricing inefficiency. You know, there's a bunch of effectively I guess, anomalous demand for treasury bonds at the end of the month, which, if it's large and kind of random, is probably going to affect price. So this guy, he's behaving in a price insensitive way because he has misaligned incentives, for want of a better word. He's not incentivized necessarily to trade at good prices. He's trying to do something else. He's trying to just tidy up his book to avoid an awkward conversation. So if this were true, what would we expect to see? Well, if we imagine that a world where the fair price of treasury bonds was approximately constant during the month, we'd expect the excess demand from these kinds of purchases, right, guys like this, to come in and push the actual market price of treasury bonds up higher than the otherwise should be. Which we would see as excess returns, possibly to treasury bonds towards the end of the month. Then at the start of the month, we expect that price distortion to relax back down. Okay? What would that look like? That would look like reversion. That would look like negative returns to treasury bond assets or similar high quality government debt at the start of the month. Now, do we see that? Well, how do we pose that problem? Yeah. Well, you know, this isn't rocket science, right? We look as directly and as simply as possible for that effect. Okay, so we think we'd observe the historic returns of investable treasury bonds to be higher at the end of the month, lower at the start of the month. The distortion reverts. What we don't do is set up a simulation of a trading strategy. Right? That would not be a simple, direct way to look for that effect. That involves making decisions. It involves a complicated sort of system where we've got to have buys and sells and parameters and decisions around that thing. So that's not a simple, direct way to look at a market effect. We want to just look as directly, as simply, and as efficiently with our data as we possibly can at whether we see this thing. So, you know, dumb it down, right? Do the simplest thing. Don't jump to the end of the process or do something complicated. So probably the most simple, most direct high-level analysis looks something like this, right? We go and grab treasury bond returns over some reasonably long recent period, and then we just look at average returns over here as a function of the day of the month. And what we expect to see, or what we would see if our idea had kind of validity, is that the returns at the start of the month would be lower, you know, as our mispricing, as our excess demand blows off at the start of the month, be lower. In the middle of the month, it's going to mess, whatever. And we'd expect returns at the end of the month to be slightly higher. So our very first, very most simple, very most direct thing to look at is this. Okay? Get treasury bond returns for some period, look at the average return by the day of the month over that period. And if it doesn't look like this, there's no point, or it doesn't look a bit like this, right? There's no point flogging a dead horse, right? If we don't see any evidence in the recent past of the effect that we're looking for, then when we think that it should exist, right? Then there's no point, trying to look for something else. We want things to be obvious. We want things to be clear. So this guy, I invoked him last week. He's going, we want effects so big and obvious we see them in every reasonable way that we look at them, at least at first, because the more carefully we look, the less obvious things used to look. And this is why it's important to not do some kind of grand analysis, right? Because you want to get to the point of failure really quickly. Okay? You want to get to as quickly as possible to the first initial high-level analysis that effectively disproves the idea. Okay, so this is your main goal, right? How can you disprove the idea as quickly as possible? Now, don't make big plans. Definitely don't make big plans, but it's good to make little plans to do little things. So we'll make a little plan to do that simple analysis, which is going to involve getting some data, calculating returns for each day, grouping them by the day of the month, calculating the average return for each day of the month, I should say month. And then if that doesn't look promising, then that's a shame, right? Then we probably give up and look at something else. If it does look promising, we got to call our own bullshit. We got to say, hey, look, what other than our pet idea could explain this? And then we dig deep into this stuff. Okay. So, have we got any questions that are worth picking up before we look at that, Chris?
We've had a few. I've answered a few just in the chat, and I'll answer most of these myself. But there's one here. Carlos is asking for your opinion specifically. He says, "What percentage of ideas typically get rejected straight away in James's experience?"
I don't know. I think it depends if it's something that I've come up with that I think makes sense. So a lot of the ideas of things that I look at from talking to people, like, the number one useful source of ideas is copying them off other people. So if I'm talking to someone who's running something profitably in production, I'm going to have a fair idea, depending on who it is, but I'm going to have a fair idea that there's probably something there. And at least most of the things that I've traded, are variations on a theme, right? They're variations on a solid idea that I know has some basis. However, sometimes I get pet ideas about certain things, and most of my pet ideas that make wonderful sense in my head probably don't pan out, right? Most of them probably don't work. Certainly recreating most things in papers is troublesome, right? Not in the sense that they've necessarily done anything wrong, but the results tend to not be, so the actual analysis tends to be right in as far as they've done it, but it doesn't necessarily tend to be useful. Like what you'll find is lots of things that are reported in papers tend to be microstructure effects, or they tend to be a premium for taking risk, or stale prices, or some other thing. So I would say most of the things I nick off other people are promising. Most of the things that I come up with on a whim probably aren't. And Rick says, but this kind of analysis is backtest. No, I wouldn't say data analysis was a backtest, right? You know, I'd say a backtest is a simulation of a trading strategy. You know, data analysis on past data is data analysis, right? It is analysis on data that existed in the past. But what I'm talking about when I'm talking about a backtest is a sort of event-based simulation of buying and selling and margin calls and, you know, all that kind of stuff. Right, that's probably enough questions for now.
Cool. Yep.
So how are we going to do this? Right? Well, first we need to get some data, and we should get, you know, there's always a million things we can do at any one of these stages, and we should do the easiest, right? We should do the easiest, closest thing that gets us moving, because we can always come back and we can always look at other things. And now, what I decided when I was doing this, and I wanted a free source of data that anyone could use, is we can get daily prices of the TLT ETF from Yahoo Finance. So if we go onto Yahoo Finance, we can type in TLT and we can get daily prices, right? These are trading days here. And then for each trading day, we have an open price, a high price, a low price, a close price, and an adjusted price. And this is a summary of the price that TLT, iShares Treasury Bond ETF, traded at during that day. Okay. Now the open, that's the first trade of the day. The low is the lowest trade of the day. High is the highest trade of the day. And the close is the price of the closing auction for that ETF. Now, thing that you must know when dealing with this stuff is you can't trade any of those first three prices. Those are prices someone got, not a price that you could get. The close, on the other hand, is the auction price for that share. In this case, an ETF. So what happens is traders put in orders to buy and sell certain quantities of the ETF at certain limit prices. Then the supply and demand curves get drawn, and the actual price of the auction is the price where the maximum amount of trading happens. So the closing price represents effectively a batch auction. So effectively lots of liquidity goes in there and you'll get a reasonable price for the buying and selling of that instrument. So closing price is a price that would be relatively accessible for you to get if you were a small trader. Now you'd have very little impact, if any, on the TLT close price. So use the closing auction price. That's just the close column. Also use the adjusted closing price, right? Because TLT pays distributions. The adjusted close price is the price of TLT adjusted for those distributions. So if this guy here was the actual price of TLT, it was paying a distribution here, we'd expect the actual price to decrease, right, at the point that this goes ex-dividend. Now, that is effectively a artificial jump, right? Because it paid you a dividend at the same point that went down in value. So the adjusted close price adjusts for this, right? It makes the history of the stock price lower such that we take out this discontinuity. That means that we can calculate returns on that adjusted close price without having to think about distributions and things like that. Okay? So nice and simple. Our job is to do the simplest thing we possibly can so we can move fast. So we get Yahoo Finance prices, we get adjusted close prices, we can calculate our returns off of those. Okay? So now I'm not and don't really like writing little bits of plumbing code. So I just asked ChatGPT to write me code to get, this is what I wrote. Write me some R code I can run in Google Colab to get adjusted OHLC prices for TLT from Yahoo Finance in a data frame. And then I had a bit of a chat with it to get it to let me do what I wanted. And I got some code that lets me get those prices. And it actually works, right? So this is me. I'm in Google Colab. I've got it using the R kernel, and this is the code that it wrote for me. If I run that, it's now defined a function called getOHLC that I can pass a ticker and a couple of dates to, and it's going to give me daily prices for that instrument. So here I can run it, yeah, and I can see if I've now got a data frame in R called TLT that has daily open, high, low, close, adjusted close prices for that guy, yeah, which is pretty cool, right? You know, that we have various bits of code lying around that either me or Chris has written to do this kind of thing, but I thought it was very cool that I could do that in a minute by typing stuff into GPT. So for the rest of this, or for at least some of this session, I'm just going to be doing the analysis, writing code in here. Once we've got past the very simplest thing, we'll stop writing code and we'll jump back and I'll show you things that I've already done. Okay. Yeah, so yeah, ChatGPT is awesome as far as I can tell. Very, very, very cool. Now I'm going to be writing R. I'm going to be using Google Colab here. The language that you use doesn't really matter. I'm just using this because I like it, and it's convenient for you. So the thing that I want you to grasp through this is not the precise syntax that I'm using or anything like that. Just why I'm doing what I'm doing. Yeah. So I've got my data. Now, the first thing that I'm going to want to do is just check that I've got the right amount of data. Okay. So here I'm just going to look and say, well, hey, how many records have I got? What is the minimum? What is the minimum date? What's the maximum date? And you just want to never trust that you've done the right thing, right? We've just used a bit of code that was created by an AI. It's good to not trust that it's doing the right thing. So we got the right amount. We got data from 2002 to 2022. That's kind of cool. Let's just check we don't have any duplicates, right? Because duplicate data on a given, it's good. It's nice to assume that if each of our rows is a day, then it actually is, right? If it's not, that's going to be a problem. It's going to be a pain. So here I'm just going, hey, look, give me the account of the number of records by day, right? So this should return a bunch of ones, right? Give me an account of the number of records by day. Let's see if we've got any that aren't one. We should get nothing from here. And when you're writing code, before you hit run on anything, just think about what it's going to do, right? Don't just sort of randomly type things and hope for the best and get surprised by the results. When you do things, think about what you're about to see and then make sure you do see it or don't. Either way, it's going to be interesting. Right, so we've got the amount of data that we think we got no duplicates. Probably want to plot it, and if you're like me, you're going to have a good idea of what TLT looks like. Right? If you're an enthusiast of treasury bonds, as I am, then you'll have a good idea of what it looks like. So just sort of check that it looks like what you think. If you don't have a good idea of what TLT looks like, then just get the chart up on TradingView or something and check it out. I can't type and talk at the same time. So let's see, does this look like TLT? Yeah, that looks like TLT, lovely, and until recently. Yeah. So what have we done? We've got data as quickly as possible by asking an AI to do it from the sort of easiest source that we have to get it. We've done some cursory checks, right? We've checked it's got the right number of records. We've checked it hasn't got any duplicates. We've checked that it looks like TLT. Yeah. So what is our next plan? Well, let's go back to my slides, right? Our next plan is to calculate returns for each day. Okay? Because what we want to do is ultimately we want to create this output. We want to create the output where we have each day of the month, and then we have what are the mean returns for that day of the month. Okay? So first thing we need to do is calculate the close to close returns for each day for our data. So you can imagine this looking like this, right? You know, this is these lines here. This is the main trading day. We've got the close price of day one over here. Then in between here, we've got the period where there's no trading, right? Then we open again, trade over here, close over here. Now our first return calculation is the difference between these prices, right? Between the close at the end of day one, close at the end of day two. That's the return observation that we're going to flag on day two. So, you know, we've got no return observation over here, right? Because there's just one price. This one is the difference between day two, day one. Same, this guy over here, this is the difference between day three and day two. Okay. That makes sense. Easy stuff. So now we need to do it, right? So when you're doing data transformations, the most important thing to do is to visualize in your head what the data looks like. Yeah. Now the data that's important to us at the moment looks like this. Right? For each day, we have an adjusted close price. Now we want to visualize in our head what the data we want looks like. And that looks like this. It's exactly the same data in the sense that we have the same number of rows. Each row represents a day, but we're tagging a column on the end of our data, which is going to be the log returns from that day to the previous day. So this guy here is log returns from here to here. This guy here is log returns from here to here. Why are we doing log returns? Because we can add them up, right? And add log returns up over time, which is what we're doing here. If we were trying to add simple returns over time, that would be problematic because it wouldn't really penalize volatility when we're aggregating. So easiest thing to do, calculate log returns, then we can sum them up nice and easy. So should we do that? So our data looks like this, right? Each row contains open, high, low, close, adjusted close observations. What we want to do is add a column on the end, which is the log returns, which is so that our record here would be the log of that divided by that. The record here would be the log of that guy divided by that. We could do that using the mutate function. So I'm going to make sure that my data is ordered correctly. So I could use mutate function in dplyr. That just means stick a column on the end. I'm going to create a column called log return, which is the log of the close managed. That's the log of the close divided by the close, the record before, which is what that lag does there. Yeah. Let's just make sure it did that. Cool. There we go. Rick, what are you arguing about, dude?
He wants to know why we're not using log returns, and I just said, look, they're easier to work with for this sort of analysis, and it won't make any difference for what we're doing here at this stage of the analysis.
Yeah, you just I mean, you can always convert them back, right? You can add them up and convert them back, but we're just looking for the shape of them for each month. Like, it's really important to focus on what matters and not what doesn't matter, right? You know, our mission here is to move as quickly as possible, do the simplest analysis. What we're trying just to do is look at the shape of a chart, which is day of the month returns on the y-axis, right? Trying to do that as quickly as possible so that when we get to that, we either go, cool, this looks promising, let's dig deeper, or we go, oh, this doesn't look very good, let's kind of lose this, right?
Mm-hmm.
Sorry, I was just looking at sort of chat thing. Yeah,
that was great. Thank you.
Yes, I'll try and. What was I doing? I was calculating. I was calculating returns, right? So, oh no, here I've got my returns here. Oh, it's back on here, right? Yeah, there I go. There we go. Right, so I've got my returns, my returns calculations here. I'm going back to my slides. My next mission is to group all of those return observations by the day of the month and then calculate the mean log return for each day of the week. That makes sense? Because what I want to do, I've got data that has one row for each date. Okay? And what I want to turn it into, this is really long data, right? I've got 5,000 records here. Yeah. What I want to do is squish it down like an accordion. I want to turn it into 31. Don't know what I did there. I want to turn it into 31 records, one for each day of the month, and then I want mean returns over here. Okay. So how do I do that? Well, I've got two transformations that I need to do. First, I need to add a column to my data which has the day of the month in it. Second, I need to do this aggregation or this reduction. I need to reduce it down to 31 days, and then I want to calculate my mean returns. Okay. So let's do that. So let's look at my data. I've forgotten what my data looks like, so let's go and look at it. So I got my date, I've got my adjusted return, I've got my log return. Now the next thing I need to do is I need to add a column which has got my day of the month on here. Yeah. So let's do that. So add day of month. Let's add one on here. Dubra day. What is it? Is it day? I think it's day. So I think, well, that's going to do. Let's just have a look. That's going to stick a column that has the day of the 30th has the 30 on it. 31st has a 31. First has a 1 there. Okay. Let's also get rid of NAs in our log return here. There we go. So now our mission, if we look at this guy, what's he going to look like? Should look the same, but we've got a day of the month on the end, and we haven't got an NA anymore. Okay. Rick, can you stop talking about that?
Go on, I got it.
It's really distracting, right? Can you just leave it alone? Dude, no one cares. Yeah.
Sorry, I was trying to deal with that.
Sorry. So now our mission, right? So we've got the day of the month here. We've got our log return. Our mission now is to group by the day of the month and calculate the mean log return for each day of the month. Right? So let's do that. We'll get our TRT thing. We want to group by day of the month. Now we want to summarize, and let's get mean log returns of our log returns, and let's get a median in there as well, just so that we know we're probably going to look at that in a minute. So let's just check that worked. No, what's it done wrong? Log returns not found. Haven't got an S on the end of it. So there we go. Right. So now what we should find, if we look at the whole lot of that, we've got 31 records. We've got a mean log return. We've got a median log return. That is good. Right. So let's put that in object called, day of week returns. Now I've got an object here. Now, what is my next mission? Well, my next mission is simply to plot that. Right? Let's plot that and let's see if we see the same kind of an effect. Okay. So let's go do that. Right? So here I'm taking this guy. Let's go day of month returns. And let's plot the day of the month on the x-axis. Let's plot mean log returns on the y-axis. What do we see? Well, this is the point where we've got to, or we've done the very simplest initial analysis that we could. Right? We want to look at all of the data that we have available, and we want to look for evidence of one thing and one thing only. Right? We're not looking for precise things. We're looking for stuff that leaps out at us and smacks us in the face, right? And all we're looking for is returns at the start of the month being significantly lower than returns at the end of the month. And that's exactly what we see here, right? So in this initial analysis, we quickly got to the point where we can do a quick comparison of returns at the start of the month with returns at the end of the month. You know, it's not a perfect analysis in any way whatsoever. For example, the mean of this data, we're looking at relative returns here and here, right? The mean of this data is going to be somewhere a bit lower than that, but it's going to be positive, right? But we don't need to demean this data in order to see that these returns are lower than these returns, right? Yeah, we're plotting log returns up here. We could convert them to simple returns before we do this plot, but we don't need to, right? We know it's going to be exactly the same shape, whatever we do. Okay. And that's the important thing, just move fast, look directly, don't get hung up on dumb stuff that doesn't matter. Okay. You want to work out the thing that you're looking for. The thing that we're looking for is what's the relative difference between here and here, and look as directly as you can and as quickly as you can for it. Don't be prissy, don't get distracted, don't do complicated, unnecessary things. Don't look at things that you don't need to create this quick comparison. Your mission is to get to the point where you throw the idea out as quickly as possible. Okay. And we failed to do that. Right? So we've got to the point where we have our initial analysis here, and it actually looks pretty good. Right? So we've failed to reject our idea. Okay? So our next step is to try a bit harder to reject it. Remember, we want to be kind of disproving things, right? We're not sort of hopefully trying to find something that looks really good. We're trying to disprove stuff. Now, one immediate thing that we can do, because we've got the data, is we can plot the median returns, right, for this. And, if our returns data was dominated by a few outliers or something like that, we might expect it to look different. But we look at this, it doesn't really, right? Market effects like this that are playing out on daily, monthly basis are noisy, but we can see a pretty clear effect here, at least in the average data that we're seeing here, where returns at the start of the month are on average lower than returns at the end of the month. Okay. And that was the only thing that we're looking for, right? We're not trying to do a big science project here. We're just looking for evidence that we can throw this idea away. Okay. So Alex said it'd be nice to run a t-test and things to confirm that difference in the means is statistically significant one, right, from the end of month and beginning of month. Yeah, so you can do that kind of thing, right? You can just sort of shuffle your returns around, and you can see what is the chance that you would observe this kind of stuff by random and things like that. I'm going to show you some techniques that you can use all the time for things like this, where which are pretty good at trying to get some intuition around whether you have a significant effect, or at least a kind of consistent effect over time, without having to think about statistical tests and stuff like that. So this is my mission now, right? So we haven't managed to discount this idea, and we haven't managed to throw this idea out yet. So what do you do next? Well, you keep digging, right? You keep asking the question of what things other than my pet theory. So I've got a pet theory about window dressing effects, right? But here I'm asking, well, what things other than my pet theory could explain this effect that we're seeing here? Okay, and this requires some level of creativity, right? You're going, hey, well, look, what thing could be causing this, and how do I look for? But there's some things that are always true, and one thing that's always true is and the most likely thing, to be honest, is I've made a mistake. That's if it looks really, really good, your number one most likely thing is you made a mistake. You somehow managed to look ahead in your analysis or something like that. The other thing that's often true, and a lot of your comments in the questions are thinking about this, right? You could go, well, hey, look, it could just be randomness, right? Market outcomes, especially if we're looking at daily returns over a monthly cycle or something like that, they're pretty noisy and variable. Now, I might have my pet reason why this trade makes sense, but if I'm honest, I'm only looking at it because other people have told me about it, right? Or similar kind of things. So there is a chance that this could just be randomness, and we'll look at that, right? But what other things could be true? Well, another thing could be true that we're actually being rewarded for taking on extra risk. This may be something through someone perceives treasury bonds to be riskier at the end of the month. Maybe this trade is just a reward for being long at the end of the month or something. Another thing it could be, it could be caused by or at least in part, by some other large flow effect, such as end of month rebalancing or something like that. Or it could be some sort of structural effect around the close prices or something like that, okay? So we won't go through all of this, right? Because we've only got a certain amount of time, but we'll look at a few of them. And the process is exactly the same. You pick something, you think about what else could explain it, what would you need to see in the data if that were true, and then once again, you look as directly and as quickly as you can at that, and just keep asking the questions. Yeah. Now, it could be randomness or luck. Now, what are ways that we can tell whether it should be randomness or luck? Well, one way is to run statistical tests and things like that. One way is to go, hey, look, we observed this pattern of returns at the start of the month being lower than returns at the end of the month. What is the chance that we observe that just by randomness? We could take the, average. You could take the mean and standard deviation of TLT returns, sample from it loads of times, and just see how many times we got that kind of anomaly just through random sampling of stuff that looks like it. Or we could take the returns from TLT, jumble them up and do it. Okay. Or we can, there's a million things that we can do. But we won't do that, right? What we're going to do is to look at something much more sort of directly relevant to the trading problem, which is to go, well, do we see this effect consistently throughout the period that we're looking at? It's all very well that we've taken 20 years of data and we squished it down into a single aggregate of all of the days of the month for all of those 20 years. But if it needs 20 years of data to play out on average, that's not that interesting. On the other hand, if I look every 2 years and create one of these plots and they all look similar throughout time, that's both giving me confidence that it's less likely to be random, but also giving me confidence that I can see it persistently, see the effect persistently through my data, which is important when I'm thinking about whether I'm going to be able to trade it in the future. So that's number one useful thing that you should do with pretty much everything, right? If I see an effect on average by aggregating nearly all my data, what if I just split it up into sub-periods? Do all my sub-periods look the same? If they don't, do I understand why they don't look the same? Yeah. So that's thing number one. Does it look sort of consistent over time? Now, thing number two, there's no reason to think that TLT is special. Right? This effect should play out in similar ways in similar assets. So if I don't see it in TLT, if I see it in TLT, I should see it in other duration US treasuries. I should see it in treasury futures as well as ETFs. I should see it in other international government bonds and things like that. Yeah. So first thing is time. Second is different assets, right? We should see this effect in different assets. There's nothing special about the particular thing we're looking at. And if there is, that would be worrying, okay? So first thing, how do we see how stable this effect is over time? Well, really simple, right? Just split our time periods into multiple sub-periods and plot that thing for each sub-period. Another thing that we can do is we could create a single metric that we can plot as a time series. So one thing that we might choose to do, it's hard to plot the shape of this chart as a continuous thing because it's lots of observations. But what we can do is we could take this and we can collapse it down into a monthly or yearly metric. And that metric might be the returns at the end of the month minus the returns at the start of the month. We can then plot that over time, right? We could plot that by month, we can plot that by year, we can even plot it daily, we can even plot a cumulative plot, and that'll look quite a lot like a back test, right? So I would just show you this one, right? Because I don't want to be writing too much code in front of you. So here, what I've done is I've got data here from 2002 to 2022. Right. I said I just want to split all of those observations into 5 groups. Right? I've got group 1, 2, 3, 4, 5. And there's roughly 4 years in each group. You know, I don't care that these don't align with end of month. I'm not trying to do anything precise here at all. I'm just going, I've got about 4 years of data here, 4 years of data here, 4 years of data here, 4 years of data here. Now, all I'm going to do is try and recreate the analysis on each of those subsets of data. And what I'm looking for is, does each 4-year period look roughly the same? So I do this and I plot it, and I see effectively it's noisy, right? But you see effectively the same pattern in each of these subperiods. You know, you see the same shape of this chart with lower returns at the start of the month, higher returns at the end of the month in every single one of these 4-year subperiods that we have. Now, what does that tell us? Well, it sort of hints at the fact that this effect has been relatively persistent over time, you know, and relatively similar. It hasn't changed that much. Now, it's a noisy effect as things are, but at least if we're sampling 4 years at a time, we're seeing it relatively consistently all the time. So then we go, well, how do we break this? Right? Well, one way to break it would be to break it up by year. And remember, we're always trying to break it. Right? We know that at some point this stops working. Certainly, if you looked at every single month, then you're never going to see this effect every single month. So we just kind of keep going down, keep trying to understand the limit of how we observe it. And you can see here, this is the same thing broken down by year. And you can still see that you sort of see it, albeit noisily, quite a lot, quite consistently throughout this sample. You know, so it's hard to read stuff like this sometimes, you know, but it's kind of nice because it's honest about the noisiness of your data. But you do see this sort of general effect most years, most of the time. So we've failed, right? We failed to completely discount this idea so far. You know, certainly there seems to be plenty of evidence that it's historically been there, and we have some kind of story around it. Let's look at it in a different direction. Right? We said when we're looking at time, right, seeing how consistent is it over time, we've got two potential strategies. One is to just slice the period into subperiods and look to see if they're the same, if they look sort of the same. The second is to create a single periodic metric that we can plot over time or aggregate over time. So that's what I've done here. I've created a metric which is the return of the last, for a given month, it's the returns of the last 5 calendar days of the month minus the returns of the first 5 character days of the month. Yeah, don't know why I keep writing week. And we can plot that for each month here. So this is each month that we have, and you can see that, you know, overwhelmingly, you can think of this as like the returns of a long short strategy that's long at the end, short at the start, right? And you can see that overwhelmingly the returns are positive. It's a good thing, you know. Of course, you're not making money every single month if you were doing this, right? But you can see that the data, that, you know, the returns are pretty consistent. You've got pretty consistent positive returns through the month. And, you know, most things that are playing out on this kind of frequency don't look like this, right? They look far more noisy. Yeah, I'll share this Colab sheet with everyone, okay? So then we can do the same thing for the year, right? And you can see that it's been effective most years. You've got 3 years in this sample where this strategy where this effect didn't present itself in the yearly data, but you've got 18 years or something like that where it did. So building up a picture of a fairly consistent effect, at least in long duration US treasuries. What do we do next? Well, next we can look at, do we see this effect in similar assets? There's nothing special about TLT. I mean, there's never any precision with any of this stuff, right? Like what we're talking about is a general tendency for some people to price insensitively bid up quality assets at the end of the month. There's absolutely nothing precise about that whatsoever. It's a noisy effect, and if you see it in one high quality government asset, you should see it in others as well. And so we look at that, right? And we've looked at 10-year treasury notes here, international government bonds, 20+ treasury bonds. And, you can see that this is less volatile than TLT because it's lower duration, obviously. But you see the same kind of effect, right? You see the same effect here in international government bonds. Obviously, you see the same effect in TLT. So we've also failed to kind of discount this idea along the different asset axis. So we found it to be consistent over time. We found it to be consistent over similar assets, albeit that this isn't a very thorough study that we've done here by any means. So, at least, and we can go further, right? We can do much more sort of tests, but I don't think it's worth it at this stage, right? You learn to get some intuition around these things. If you don't have the intuition yet, it's good to play with random data in order to get that intuition. But certainly when you're looking at that, you're going, hey, we've got a very obvious and very clearly persistent effect that seems to be there in one asset and assets that are like it. And that's a good thing. Right? It's a good thing if we're looking to trade something. It's not necessarily a good thing if we're looking to disprove something. But we go, we look, we collect data, and then we weigh it up at the end. Now, the final thing that we'll look at here, because the process is the same, right? We just keep going through calling bullshit on ourselves, looking for things, trying to be disappointed, and trying to collect up evidence on how strongly the data we observe matches our story about the world. Okay. So one thing that we might say is, and especially if we're sort of academic, right? We'd go, hey, look, expected returns are actually usually just a premium for taking on extra risk. And we go, well, does that seem to be true? So we ask the question, right? We go, hey, look, what would we observe if that were true? Well, we're observing the returns for treasury bonds being higher at the end of the month, okay, and significantly lower at the start of the month. So if this was simply a premium for taking on risk, we might observe moves in TLT to be larger at the end of the month. So here what we've done is we've just calculated the periodic returns for TLT, calculated the absolute value of them, and plotted that for the day of the month. What do we observe? Well, we certainly don't observe the absolute moves being larger on average at the end of the month. In fact, we sort of observe the opposite, right? They're larger at the start of the month where we got the most negative returns. So the story that this effect could be a risk premium rather than a pricing inefficiency seems to be wrong. So that's interesting, right? That's sort of evidence in support of the effect that we're looking at, or at least evidence that something else that we're not expecting isn't isn't driving those returns. Now, this is probably the sort of the end of that kind of exploratory research that I want to do. There's obviously a lot of things that if I was doing this for real, I would be doing. And, I'd keep going around this circle, trying to discount all of these things that I can think of, trying to learn what is actually causing this effect and isolating it. Yeah. So I'm not and it's important to kind of, I think, to explain what I'm interested in and what I'm not interested in at this stage. Like, I'm not interested in sort of validating the statistical significance of stuff at this point. I kind of past that. Like, what I'm trying to do now, if I'm going through this process, is I'm trying to understand actually what is causing this effect. Like, what sort of play of humans doing things and buying and selling stuff is creating this dislocation. Is it, I think, I can observe it, right? I can see the effect pretty clear. I have a story around it. What I'm trying to do is trying to match what I see in the data with the story that I have. So one sort of interesting thing that I might be interested in is, to what extent does other stuff explain that thing I'm seeing? And one of those things might be rebalancing between stocks and bonds at the end of the month. If we think of wealth management as a big pool, pretty much, of a bunch of stocks and a bunch of bonds, if stocks have gone up a lot in that month, it's likely, just on aggregate, they're going to be sold to buy more bonds as part of a rebalancing process. Now, if those flows are particularly big, they possibly distort prices a bit as well. So I could try and isolate, to what extent is the negative returns that I'm seeing at the start of the month actually caused by the fact that, on average, wealth managers and things are coming out of stocks at the end of the month, selling, buying bonds, driving those up at the end of the month on average, which then decays at the start. And I might, for example, look at returns at the start of the month conditional on returns of stocks at the start of the previous month, to go, hey, look, if I see some relationship there, that sort of, if I see no relationship there, that's consistent with my window dressing story. Because I don't know, are people more likely to window dress if it's gone up or gone down? I don't really have a view on that, but I do know about rebalancing stuff. So if I see the returns of bonds at the start of the month explained to some extent by the returns of stocks, say, during most of the previous month, then that tells me there's probably something else going on here. And indeed, if you look at that, right, which I have, I won't spend much time on that. If you look at that, you'll see some evidence of that. Right? You'll see. Where can I go? Right here. So here, this is the returns at the start of the month, conditional on the size of the move in stocks from days 1 to 25 the previous month. You see that if stocks moved a lot, you'll see, well, incredibly positive the month before, you'll see negative returns to bonds the previous month. And you see a pretty linear relationship given how noisy this stuff is. Now, I didn't really want to get into that, but that's an example of dealing with the anxiety that comes out of the research process. You're constantly just trying to dig in, trying to understand the effects. And it's uncertain, right? Like you never know the answers of these things. You can only sort of dig and try and see how much evidence points in the same direction. Now, people kind of want the the comfort of things like t-tests and p-values and things like that. And those things are useful, especially if you don't have the sort of, if you haven't done this a lot, right? It's useful to know that stuff. It's useful to do simulations with random data. It's useful to get intuition. But ultimately, the thing that you care about isn't, is this thing that I observed in the past statistically significant? You know, that's not the problem that we're trying to answer here. The problem is trying to understand the causal mechanism of what's creating the mispricing, which is much harder, right? It's much harder. It involves some level of creativity, thinking about what drives things, and it involves accepting that you can never know. The best you can do is do your best, look for stuff, try and weigh up a lot of evidence pointing in all kinds of different directions. So the kind of final point on research thing is accepting that you're never going to understand exactly what's going on. Right? Like it's a very noisy system. Like you could never be precise about the aggregate behavior of pussies, idiots, and bots. Right? You know, it's a human dynamic adaptive system. And the best that we can usually hope for is an idea that makes sense, right? We understand why there is a mispricing. We've got a variety of different evidence aligning in a relatively consistent way with that idea. And we've got a reason why that idea might persist into the future, right? We understand why it's been there in the past. We understand why we think it might persist into the future. And that all comes down to trying to understand what's causing it, trying to understand in what way the data is consistent with it, and trying to understand why it sucks. You know, what sucks about this such that it will persist. Then ultimately, though, you know, this is all very well, talk about this stuff. Ultimately, you've got to deal with the uncertainty of it all, and you've got to place some bets. You've got to get to the point where you're going, I can't possibly know if this is going to hold up in the future, but I have an idea why it exists. I have some supporting evidence in the past data consistent with that. I have some worries and inconsistencies about that. I have a reason why I think I can exploit it. Then I got to get to work. I've got to design a set of processes to actually exploit that effect. Okay? And when I do that, I want to design a set of rules, a set of processes that are as simple, direct, cost-effective, time-effective as possible. Yeah? So I want to be very simple. So an example of this, based on the research that we've seen here, we see a lot of evidence of very kind of consistent, blunt effect. Yeah? So we would do something like this. You know, last thing we want to do is get complicated. We haven't seen any evidence that justifies any kind of precision being justified here. We do something like this. Right? We get long TLT 5 days before the month end. We reverse short on the month end. So we've now switched from being long to being short. Then we cover the position after 5 days and sit flat. We would trade market on close at small size, you know, because I haven't simulated any price impact. This simulation here, sort of finger in the air simulation here, assumes fixed tier fees at IBKR. So, you know, your rules are super simple, right? Like you can just write them down in 3 bullet points. And that's all that's justified here. You know, most kind of effects that look like this should only need rules like that. And maybe if you kind of dig into this, you can understand it better. Maybe if you can isolate the effects from this kind of thing and other kind of systematic rebalance effects, you might be able to justify something a bit more complicated. But keep it simple, keep it dumb. So the important thing is there's a difference between the effect and the set of rules that you use to harness that effect. So I've come to the end of what I wanted to talk about. So don't put cart before the horse. Investigate market effects first, not strategies. Core bullshit. Don't believe yourself or anyone else. Chunk down, right? What you don't want to do is get worried about a whole load of stuff that you don't need to worry about, right? Your focus needs to be on falsifying ideas, right? What is the quickest way that I can prove that this idea is dumb so I can go and do something else? And that involves some creativity, right? You don't want to get stuck worrying about creating the perfect bit of analysis. You can often disprove ideas on imperfect analysis. Then you can keep going. So don't be prissy. Don't get stuck trying to fix every single problem, deal with every single thing. Don't do things that you're going to need in the future, but you think you're going to need in the future, but don't do now. Always do the simplest, most direct thing that could possibly work. You keep doing that. Right? You can always go back. You can always go and fix things. You can always go and change things. You can always revise things. You can always look at things in different ways. Don't get stuck with the sort of prissy quant police thinking you have to fix every problem. Move fast, get messy, just go into it with a clear head, understanding the assumptions you're making, understanding your sources of discomfort, being clear what you think you know and what you don't know. Just take an inventory of all of that stuff. Then you'll have this kind of, you have this sort of box of hope and anxiety and uncertainty. And ultimately, you sort of shove that all down. You make a decision on what you're going to do, and you implement a set of processes to harness the edge, right? And the main thing is that the mental sort of model that you've got to have is someone curious and someone skeptical, not someone hopeful trying to prove themselves right. So I hope that has been a kind of useful sort of view over my shoulder of the kind of things that I'm thinking about when I'm doing this stuff. Any general comments or questions on this stuff?
James, if I could just say one thing really quickly, one thing you mentioned there right at the end was, you go through your research process, you would, get yourself to the point where you were okay with the uncertainty, you'd make a decision about whether you were going to trade it or not, and then you would go and implement a set of operational procedures to harness the effect. And I just wanted to make the point that, that step of implementing the operational procedures is exactly not what we've done here. It's, here is the research process, which is entirely separate to that process of putting together a strategy with well-defined rules. And I think there's a really good reason to keep them separate as well.
Yeah, because you wouldn't know what you were doing, right? Like, there is a sort of I guess a style of trying to come up with quantitative trading strategies that I think is probably made famous by World Quant or those guys, which was just a data mining of the trading rules themselves, where you go, hey, look, let's just sort of try a bunch of random rules, right? And see if just a bunch of actual trading decisions of buying and selling makes money. That you got to be very, very, very careful with that kind of stuff, because you're going to end up with something that you don't understand. At best, what it probably is a very sort of noisy way of harnessing a real noisy effect that lives in the market. But the problem with stuff that you don't understand is that you don't know what to do with it. Right? You can't really reason about it if you don't know why it makes money. So if it stops working, you don't really know how to adapt it. If it stops working, you don't really know how to turn it off. You can't really, if you understand a trading strategy, you can predict when it's going to stop working, right? Because you understand the causal things that cause it to make money, so that you got some leading indicators on your P&L that mean that you can turn it off before you inevitably lose a lot of money with it, if you've done it well. Right? If you don't understand the trading strategy, you don't have any of that. So I strongly recommend that you focus your efforts on trying to understand what is creating the price distortion that you're harnessing. Don't just try and find a set of rules that works, because then you're stuck, right? Then it's really hard to work with that. So get really, really curious about the drivers of market mispricing. Who is distorting this market? Why isn't there enough arbitrage capital on the other side of it, or trader capital exploiting it such that this has disappeared? Okay. Just get really, really curious about those things, and it'll help a ton.
We had a question.
Sorry.
Could we go to a question from the YouTube live stream?
Yeah.
This is a good question. How would you think about sizing these trades once a strategy is in place? Obviously, it depends on your account size, but do you have any general rules for thinking about the portfolio construction problem?
Yeah. Yeah, so I guess I think of it as a whole, right? So you're trying to make a big amount of money and turn it into a bigger amount of money. So you got a certain amount of capital that you're managing, and you probably have some idea about the level of variability that you'll accept on that money. And you can play with random data to look at this, hey, look, what is a portfolio with a volatility of 10%? Well, what does that feel like? What does a volatility of 20% feel like? You probably have some idea of, roughly the amount of risk that you're prepared to take overall on your capital. Then you're looking at it and going, well, I'm just going to try and create roughly no more than that amount of risk, but I've got to build that up through a variety of activities. Right? I might be strategically long stocks and bonds, and that's maybe some alternatives, right? That's a sensible thing to be doing. I might have 2 or 3 or 4 things that look like this that I'm trading. And you need to look at each of those and go, hey, look, roughly what contribution to the variability of the portfolio do I want each of these things to have? Then you look at your constraints, right? If you're trading treasury bond ETFs and things like that, you can't. You might have portfolio margin, you might have Reg T, you might have a cash account, right? There's only a certain level of volatility that you can actually generate from a strategy. Now, this one is flat for half the month, right? So it's going to generate less volatility for you than something that was allocated all through the month. So you just got to look at this kind of setup, right? How much variability do I want? How much can I actually generate from all of the things that I'm trading, and then stick together a happy balance between that stuff. Generally speaking, when I'm thinking about sizing with these things, I'm sort of thinking about the whole amount of equity as a number. Then I'm thinking about each strategy as how much volatility do I want this strategy to contribute to that number. Maybe it's 1% for something like this. Right? Morris says, what's the sharp of the strategy? I don't know. Like, so what it is in a simulation is a very different sort of question to what it is for the next 10 years, right? But you look at that, so a reasonable Sharpe ratio for something like this would be, say, between around 0.5, maybe up to 1, right? Now that simulation will be higher than that, but we're always going to expect slightly worse performance on the right hand side of this stuff. Develop a sort of healthy distrust for low frequency back tests, right? This is a period of 20 years over here. Like this is 20 years where we're mostly looking backwards. So although that will be very, very impressive in risk-adjusted performance, you got to be a bit skeptical about that carrying on into the future. So Carlos says, is there a general rule for how much data in the past should one use? This is a really hard problem, right? Because more recent data is far more valuable than older data. But if you're looking at relatively low frequency things that involve daily data and things like that, you'll just never have enough data. So it's just a thing where you're always going to have pretty uncomfortable trade-offs associated with it. You'll never have as much data as you want. It's just one of those anxieties that you've always got to deal with.
Do you mind if I ask another one from the YouTube live stream, James?
Yeah.
Do you look at top-down macro analyses which have led you to take a trading bias and generate a system, or do you tend to start from more idiosyncratic bottom-up analysis?
I guess there's really two things that are two different things that I think about. One is the sort of incredibly high level strategic risk premium stuff. I think there's a huge amount of evidence that people are generally risk averse, and risky financial assets get priced slightly lower than their discounted cash flow, or expected discounted cash flows, or discounted outcomes, right? What does that mean? Well, that means that the total returns that you get from holding risk assets and stuff that carries or pays you to hold it tend to be positive. So there's this sort of class of, I guess, investments, that pay you to hold them, right? Effectively, and the downside of that is that you occasionally get smashed in the face, have drawdowns and things like that. And that's a thing that anyone can do, right? You just have to have sort of emotional skill in managing risk and accepting risk, and not talking yourself out of it. And that, I guess, is sort of ultra macro, ultra high level. But most of the trading thing that I'm looking at is really much kind of lower level than that. Like I'm basically going that financial assets are fairly priced most of the time. Occasionally, price insensitive parties, or people that know more or don't know more, or people who are trapped in certain conditions, or people being liquidated, create price distortions. And that's really a sort of lower level thing. And generally, if you saw the last video that we did, generally what I'm looking to do is trade the market back towards equilibrium. So I'm looking to effectively look to see when price insensitive traders have distorted the market and kind of push it back. So I don't ever have any grand macro views on anything. Right? I'm an idiot. Like I have no sense of where interest rates should be or whether asset X is mispriced over the next 12 months, or I don't do stuff like that really. I'm not sure anyone else really can do stuff like that either. At least not consistently enough that it's useful. So Ben says, I read this, how should you think about the risk of a strategy that is market neutral when you zoom out, but obviously very directional on a daily basis? That's a good question. I kind of quite like that sort of stuff because it allows you to kind of understand a little bit about why you're being paid, and it allows you to understand. So what was I going to say? I've completely lost my train of thought. Yeah, I mean, it allows you to reduce your trading costs versus, say, hedging something all of the time. So if you think about, I guess a hedged trade, like you say, if you thought some stock was cheap and you bought it, and you might sell the index against it because you wanted to hedge out your directional exposure, or you might just go, well, actually, when an expensive one comes along, I'm going to sell it. I'm only going to be in this trade for 5 days, I expect, or something like that. So I'm just okay with wearing that directional risk, and over time that directional risk nets off. Right? I think, and that's okay. All you need to do is understand that over the short time, your volatility is going to be higher than it would be if you hedged. But on the other side of it, your expected returns are going to be higher because you don't have the cost of reducing your risk, because hedging's expensive, right? So Morris says market makers can have sharps very high. Yeah, so that's a good example. Market makers are turning over all the time, right? They're providing a two-sided market, quoting both sides, and generally speaking, what they're trying to do is turn over a lot, right? So that their directional risk nets out over time. When you can do that, when you can take out the largest source of variance from your returns, you can get very high risk-adjusted returns. What sharps are retail traders expect in the upper bound on strategies that are available to them? I mean, that depends enormously on what it is, right? If it's a low frequency investment type strategy, investing type strategies in liquid TradFi markets, Sharpe ratios of 0.15 to 1 are reasonable. If you're looking at higher than that, you've got to be asking, hey, look, what's going on? Are you taking significant tail risk, or you're doing something very active that's going to take up a lot of your time? If, on the other hand, you are willing to do something that looks a bit more like a job, what you can do is you can trade like a professional trader, but in smaller venues. We've been doing that kind of thing in shitcoins or in crypto or something like that. So you're taking a market where you can only extract a certain amount of money, and you're essentially applying sort of statistical arbitrage, relative value type trading, market making type trading strategies to that more constrained market. Now, at that point, are you a retail trader? Not really, right? At that point, you have a job, really, and very very high sharp ratios are available in that stuff, but also it requires a lot of work. What do you do about tail events? Suppose there's a hypothetical scenario where an outlier that's never happened will cause you to lose half your account. Do you permit it? And if not, how do you prevent it without decreasing return? Yeah, so losing your money is very bad, right? Because like as a trader, you need money to make money. So losing it is a massive problem. So I think the advice for this is if you have some catastrophic scenario that you can hedge it, right? If you're buying out of the money, if puts, you're not expecting to make money with those, right? You're expecting that to be a cost, because reducing catastrophic risk is something worth paying for. So I think you just suck it up and buy the puts. Now there's some sources of risk that you can't hedge, right? And with those, you've just got to make sure that you've split everything up accordingly, right? Like just make sure that your worst case scenario is something that you could handle, right? Which mostly involves lots of trade-offs, right? Because if you have different commercial arrangements with different prime brokers or something like that, or you're trading crypto at 10 different venues, you've now markedly increased your operational effort. So this stuff never has easy answers. Like the right example, the right thing to say is buy the puts and spread your risk over as many venues as they could all zero and you'd be okay. But in the real world, where you're constrained with your time and effort and ability to manage things, it's not quite that straightforward. But those are the principles. Would you say crypto markets may be easier in regards to identifying inefficiencies running systematic trades? Yeah, very much so. So crypto markets, especially when you go into sort of shitcoin type stuff, are very constrained. You see a number of inefficiencies in those markets. You do in traditional markets, like sort of small cap, micro cap stocks and things like that as well. And anything that's a bit murky and a bit tricky to deal with. Do you apply anything like Kelly to sizing? No, not really. Nearly everything that if I was doing something low frequency like we're looking at here, I'd just finger in the air sizing based on some volatility I thought I wanted. If I am doing something fast and constrained, sizing is nearly always how much can I get on rather than how much do I want to get on. It's more driven by the constraints of available flow and margin and things like that than the sizing that I want. So no, I don't do anything like Kelly. Not least because I'm very uncertain on what my edge actually is in this stuff. Like I find it hard to quantify that within sensible bounds, that any science beyond suck it and see, finger in the air is justified. What turning over means? Turning over means, I mostly mean just flipping the sign. So if I'm long a bunch of stuff and then I go short and then I go long and then I go short, I'd say I was turning over. Thanks, Rick. Anyway, I mentioned Kelly should be banned. Anonymous says, great example. I'm surprised you show it in daily data. Well, for your last seminar, I'd expect smaller intraday hump. Yeah, I think I talked about a bunch of intraday stuff last time, didn't I? I was trialing out a new way of explaining things, which I don't know worked. But generally, if you're a part-time person doing investment type things, I think it's really hard to trade more than once a day. I think you'd struggle to manage that. So I think it's good to expand your horizons out a bit. Cool. Have we plowed through the questions, Chris?
We have, mate. Yeah, we've got no more questions on the live stream. We're all done.
Wonderful. Well, thank you very much, everyone. It's been fun as always. I'm pretty much done for the year, Chris. I think I'm almost done. I'm gonna start again on January, and we'll see how it goes.
Fantastic, mate. You've earned a break this year, that's for sure.
Yeah, we've done a lot of stuff.
Yeah, you're not wrong.
All right. Well, thank you very much. I will see you guys next time we decide to do one of these.
Great.